We are live. This is Senate Finance. This is the February 27th. And we are going to start to wrap things up. We've got 4 days left after today. And we'll have a discussion at the end about which bill we're going to get out. But going to start out. This is part of our discussion on migration of high-income individuals. There was an article came this morning. I saw that Massachusetts is losing younger population. It hasn't hit their labor market yet. Something is.
Did they offer a hypothesis as to why?
No.
Nothing.
Texas.
They say where they're going?
No, they said the Carolina, North Carolina, Texas.
I don't know, population
Tennessee.
grew down in that area.
Yep.
Yeah.
Has been for the past 10+ years.
So that's-
Yeah, no, Texas had the biggest in migration, not talking from the south.
Austin's like the 6th biggest city in the US now or something.
Mhm.
Yeah.
Whoa. Okay, so we're gonna have this, we'll have this
Carolina.
discussion, but we have Dr. Cristobal Young, who, and Dr. Young, welcome to Senate Finance. And we were told that there wasn't a whole lot of academic study, and I believe Public Assets brought your name to us. So the question that comes up is, do tax increases cause people with wealth to perhaps move? At what level might that happen, or does it not happen? Whatever your study has revealed. And we just ask you to introduce yourself for the record, and then the floor is yours.
Great. Thank you for the invitation to speak with you today. My name is Cristobal Young. I'm professor of sociology at Cornell University. Been studying millionaire tax migration for a long time, and have published a fair bit about it. I thought I would start today with case study of New Jersey, which is maybe the most sort of immediately relevant to your case. New Jersey being a small state, sort of bordering lower tax states.
Well, we have New Hampshire.
I'm seeing that I am not allowed to share my screen.
We'll get that fixed.
Yeah. New Jersey passed a millionaire tax back in 2004. That's when I was starting, I was a grad student in Princeton at the time, and I reached out to, from our professors to kick off this study, and we agreed to do it in exchange for data access. Okay, I'm able to share now. Okay, bear with me for one moment. All right, looks like this is all set up. So let's talk about New Jersey. So yeah, this was published back in 2011 with my colleague Charles Varner and I. We worked with the New Jersey Division of Taxation, worked with their microdata, so hands-on access to tax records on every top income earner in the state. People who move away from New Jersey file a part-year return in the year that they move, so observing migration is quite straightforward in New Jersey tax data. So this was the tax that they passed in 2004. They called it a millionaire tax, and this paper uses that language, though it does kick in at $500,000, not $1 million. But there you go. I didn't choose the language here, but it raised the tax by 2.6 percentage points on everything that you earn after $500,000. So income below that was not affected. So here's how this graph just sort of shows how the tax affects your actual tax burden rather than the marginal rate, which I was showing you before. But basically, after income that you're above 500,000 is sort of progressively converges to the higher rate. So that's key to understanding the impact of this tax on migration. Context, New Jersey is part of the New York metropolitan area. They have Connecticut over here. These are the sort of tax comparisons. Connecticut over here is a top tax rate of 5% at the time. Pennsylvania, running along, of course, the whole border of New Jersey, had a flat tax of 3%. So, you imagine a move from sort of Bergen County to Fairfield, Connecticut, that's a very small move, gets you, equally close to, Manhattan, but at a substantially lower tax rate. And then a little bit further out from New York City, but very close to New Jersey. We have this 3% tax rate. So there's a lot of talk about this being the context of, there's just ready movement opportunities. And the governor at the time was confident that this migration would happen. Okay, so let's look at what we see in the data. Again, this is showing the number of top filers, people who made $500,000 a year. So this sort of looking at the millionaire population in New Jersey. This dashed line shows when the tax kicked in. So we see growing numbers of top income earners despite this tax increase. So even if we do see some migration, this is a very large increase in the population of millionaires who are moving, which is certain to swamp any
We've
migration.
got one question.
Yes.
Just a clarifying question. How did you define a millionaire on this graph? Was it W-2 or assets? How did you define a millionaire?
Yeah, adjusted gross income. So yeah, but it is $500,000. Again, I'll just sort of go back to this. Again, it's, in the context of the policy discussions, they called it a millionaire's tax, and so this is just the language we're using. But it's if you're above this threshold in your adjusted gross income, so that we can see that indeed the tax would affect you.
Okay,
Thank you.
we have another question. Sandra.
Just another question, as you were looking at income changes, did you look at where people came from before they moved in? In other words, did you look at the migration in both directions as to the tax effects?
Yeah, so this is, I should say that what we've seen so far is just growing millionaire population. That does not come from migration. So the thing to keep in mind is that most of the dynamics around the millionaire population come from income. People earning over 500,000 or dropping in and out of that sort of threshold, movement around that threshold. There's much lower migration rates. So, so the next slide I'm going to show you is about migration. To start to answer that question, we didn't see in these data, we don't see where people are going, where people came from. We just see net migration for New Jersey. As I pivot from this case study to the broader US context using IRS tax records, I can speak to that question. But let's look at migration. So this is where we're expecting to see effects. The previous slide was just sort of some context. So this is in the 2000-2003. So this is 3 or 4 years before the tax was passed, and this is the migration rate, the net New Jersey migration rate at income levels. So number of out migrants per 1,000 households. And we see that there's net out migration out of New Jersey among high income earners, but this is before the tax kicked in. And we're going here all the way up to people who make, $8 million a year. So this was the context. So what happened when the tax was passed? Well, the expectation, of course, is people on the left side of the graph here, they weren't affected by this. So what we're expecting to see is rising out migration in the later period after the tax was passed among this group. So essentially, we're using this group as a control group. They were not affected. This is like the 95th to the 99th percentiles of the income distribution as sort of a control group for the top 1% that was affected by the tax. This is what we actually see. So, what you call this the dashed line is what happened in migration, in the 4 years following the tax, which is an across the board increase in migration, but nothing that you could really attribute to the tax coming into effect. You can see this gray bar is where the tax started to kick in. We see sort of basically parallel shift. So taxes increased on some people, but not others, but there wasn't a change in migration that was sort of specific to those people that were affected by the tax.
Got more questions.
Mhm.
I don't see your slide in our slide deck, so you might be answering this in the coming slides, but I'm curious, are you going to compare this to the rest of the country? Because I think the better control group might be a state that didn't have this tax. I'm assuming you probably compared it to that. I'd also just overlay that, if I'm not mistaken, 2000 to 2003 was really the wake of the dot-com bust, and 2004 to 2007 was a relative economic boom time where we saw lots of more millionaires across the whole country. So have you overlaid it with other states that didn't take this tax change?
Yeah, so you're certainly correct about these time periods. 2001 was a deep recession, and by 2003, 2004, we're coming out of this recession. So that's partly why we're seeing a growing millionaire population. So with this particular case study, we only had the New Jersey tax records. So there wasn't, we had an agreement with the New Jersey Division of Taxation to do this analysis, but not with any other states at the time. So I'm going to pivot to the full U.S. where we work with IRS tax returns for all states, all millionaires, and we can see.
Can I ask you just one question before you leave New Jersey and go to the world? When you look at people who are high income earners, did you look at and did you have any data on what percentage of those people were people who were millionaires only in 1 year? In other words, people, for example, who got a windfall, such as selling a business or something of that nature, but they were not the classic millionaire that one thinks of over time that has a high income.
Mm-hmm. This is absolutely true because most people who show up in the top bracket are experiencing a temporary spike in their income. So exactly as you said, perhaps they sold a business or something. And they're not earning this top bracket income year in, year out. It's a small subset of people who are. In other research, I have focused on people who make $1 million a year for 3 years, for 8 years, for essentially, the whole window of observation. And you see small differences in their migration rate. I think in the direction you might expect that they're a little bit more sensitive, but again, this is moving forward to a different study, but still not finding strong migration responses anywhere. We also looked at people who were sort of very high income but of retirement age, so we expect that they might be more mobile. We looked at people who earn most of their income from capital gains, so from basically stock market earnings rather than wages and salaries. Most high income earners are still folks with an office job and are being paid in wages and salaries. But you expect that people who are making money from capital, are arguably more mobile. Again, we see sort of modest differences when you start breaking out by these different groups. So maybe I will pivot. I was, other things. So let's see, just to wrap up the New Jersey case, we've got a growing millionaire population, even with some outmigration that's happening at the margins. The population growth of millionaires over this time period was about 35% compared to, a couple of percent loss due to migration. So that's the bigger story. Tax flight estimate, I've been calling it basically no effect. Our precise estimate is 1 millionaire per 2,000 moved out of New Jersey. for tax reasons. And it raised about $1 billion in new revenues each year, and produced sort of a modest reduction in after-tax income inequality. The New Jersey, the chief economist in New Jersey under Chris Christie, Governor Christie did not like our study. And so this top economist replicated this stuff. And I would just say that, you know, their point estimates were all very similar to ours, a couple that were smaller, a couple that were a little bit bigger. But their point estimates were within, you know, the 95% confidence interval, you'd say, of our study. They got basically the same results. So I think that pretty much settled that. Okay, so there's other, if I should move on, there are, of course, other states that have passed taxes like this. New Jersey was maybe the first in this period, but a lot of states have. And of course, there's also a lot of states that have no income tax, no state income tax at all. Of course, your neighbor, New Hampshire, does tax capital incomes, but not labor incomes, which again, most top income earners, the working rich, we call them. Okay, so broader question here. How should we think about top income earners? Are they sort of mobile millionaires searching for low tax places to live? Or are they more like embedded elites that are reluctant to migrate away from places where they've been highly successful? So I've studied a lot over the years, a few public, most recently 2025. These studies all work with IRS data. We have a book, and we can talk about the title of this book and you know, a little bit more nuanced interpretation in a minute, but I'll just very briefly tell you about the data. This is from the first study we did. We originally looked at 1999 to 2011, all millionaire tax filers, that's people with adjusted gross income of $1 million or more in a single year. It's about the top 0.3% of income earners in the country. And then I have updates of this to 2023 in a follow-up study that was just published. 45 million tax records. That's from 3.7 million unique millionaires who were filing over nearly a dozen years. And you know, we compare them to the general population just to sort of ask how much are the rich different. And now here we're measuring migration, both residency and migration, as just the state from which they're filing their federal tax returns. So if they filed in Vermont in 1 year and then in New Hampshire in the second year, then we're going to call them migrants. That's how we're defining migration. Okay, so tax migration actually breaks down into sort of 3 simple questions that we'll walk through here. First question, to understand this, where do millionaires live in general? Like, do they have a pre-existing tendency to favor low tax states? Because of course, you know, the basic features of the state tax system have been in place for a very long time. Like New York and California have essentially always been states that had higher taxes on the rich. Texas and Florida have never had a state income tax system. So this is the map of millionaires per 1,000 population. So the answer is, of course, in this sort of, let's call it the Boswash corridor, is where the highest concentration of millionaires are. Now we want to sort of ask how much this is sort of influenced by the tax rate. So this is this graph. So here's the effective state income tax. So like what percent of your total income do you pay in state taxes? Again, at the time when we did this study, a couple of these have moved a little bit, but you know, and on the y-axis, we have the millionaires per 1,000 population. So if we were expecting to see a pre-existing pattern of millionaires favoring low tax residency, this graph should be downward sloping. We'd have the low tax states, the Floridas and New Hampshires and Texas and Nevada should be all high up here. And generally this pattern will be declining as states increase the tax, but we just don't see that pattern at all. There's no relationship. So millionaires are scattered about the country. They live in different places for different reasons. Of course, there's variation. Connecticut's, for example, the highest, but it doesn't seem to have much to do with the state taxes. So just face validity of the tax flight story is not that strong, right?
Okay, got another question.
Dr.
Yeah,
Young,
sure.
remarkable. I really appreciate this presentation. I wonder on this slide, perfect. If you were to exclude the New York, New Jersey, you called it a corridor. I didn't catch that name, Boschfolder corridor. But if you were to exclude the states near the financial center of, some would argue, the world, and California, which also has it, I almost do see a downward slope for the rest of them, excluding those outliers, so to speak. You've ran that correlation, that trend line, extracting out those concentrated states around New York City?
I haven't done that. You could visually do that. They're all up here. There's states that have a lot of millionaires in them and also have high taxes. But so if you just sort of mentally do it, so let me just say on methodological grounds, we wouldn't want to do this. It's called sort of sampling on the dependent variable. But even if you sort of mentally did that, I'm happy to, go through this one by one. A principled way to do that would be to one by one go through the data set and sort of drop any one state and sort of see how it affects the slope. You can see that it is actually technically slightly upward sloping right now. And if you took out some of these states, probably the New York and California, it might have a slight downward slope. But again, there isn't, a great reason to do that. And again, these states, New York and California, both first started taxing essentially millionaires or very high income earners, back in the 1930s. So that's almost 100 years of experience with, taxing high income earners. And, they're still going strong, let's say. The centers of American capitalism, arguably. Okay, so the next question, so this is just sort of, background. Now we want to ask the next question. The next piece of this is just, are millionaires highly mobile? And so the basic answer here is that migration rates actually decline with income. It's not high income people who are the most mobile, it's low income folks. And I think the simplest way to understand this is like, migration is sort of a process that's not driven by people who are really economically comfortable in life. It's driven more by people who are trying to find a foothold in economic life. And the more that people are sort of doing well economically, the less likely they are to move. This is also tied up with life cycle effects. As you get more established in your career, you're less likely to move. Now, this is for the general population. Now let's plug in the millionaires, this sort of top 0.3%. So you do see a grain of truth in the millionaire mobility hypothesis that they are a little bit more mobile than, say, the upper middle class. This is getting up to people who make like $5 million a year or more. So really, some of the very richest people in the world. And there's not much of a migration increase, but admittedly, there is a little bit. Overall, millionaires have a migration rate of 2.4% a year, which is about almost half that of low-income earners. Okay, so now in general, millionaires have low migration rates. Of those migrations that do happen, how much of that is tax-induced migration? So for this, we just want to see a pattern of millionaires systematically moving from high tax to low tax states. Just some moving doesn't count. That's the kind of thing we want to see. So this is basically what we're going to do here, just intuitively. We're looking at this map of the tax differences across states, and we just want to ask, how much does this map explain the actual patterns of millionaire migration on the ground? This is also, this stage where you pull out a lot of complex regression analysis. But I've written a book about this, and I sort of wanted to find out what's a simpler way to convey what the data see. So it turns out that a simple analysis gets you to the same answer, which is very nice. So what we're going to do here is just sort. We just take every millionaire that moved over this 12-year period, all cases of migration. We're just going to sort them into 3 buckets, essentially. If they move to a higher tax state, move to a same tax state, or move to a lower tax state. And here's what you get. So first, this is people moving to a higher tax state. So that would be like folks moving from New Hampshire to Vermont. These stories, never, again, I've been saying this for a long time. These stories never get covered in the press. Just doesn't make sense to people, but they're quite common. A third of millionaires are moving to higher tax states, states that tax them at a higher rate than where they were previously living. Another 21% move between states that have essentially the same tax rate. Now, the third bucket is the case where, again, we see some evidence for millionaire tax migration. It's more common that people are moving to lower tax states than to higher tax states. So intuitively, it's more common to see. I can't say for your state specifically, but in general, it's more common for millionaires to make a move like Vermont to New Hampshire than like New Hampshire to Vermont, even though they both happen. And so this difference here is really, if these two bars were the same height, that would sort of be a wash, and we'd say, well, there's nothing really going on with tax migration. This sort of what we see, 47% minus 32%, it's about 15%. I think what this means is that about 15% of millionaire moves, overall come with a net tax advantage. So is that a large number or a small number? Again, the baseline rate of millionaire migration is quite low, 2.4%. So in any given year, 15% of those moves are tax migration. It's a small fraction of a small fraction, right? And that gets at 15% of 2.4%, works out to 0.3% of millionaires each year are moving for tax purposes.
Dr. Young,
It happens, yes.
this is all good, but the tax department, last time I asked, told me we had around 1,000 millionaires and
Okay.
1 billionaire. So, but the top 7% pay 50% of our revenue.
Mhm. They've
So
because they've
for
got the
that
income.
small number, 1 or 2 leaving is going to have a bigger or is it going to have a bigger impact?
Well, okay, so I think an easy way, there's more calculations to do to get to exactly the number that you want, and I'll spare you the sort of, the arithmetic on all that. But basically, the way to intuitively understand this is that, if a state raises their tax rates by a few points, typically you would expect maybe 1% of the millionaire population to move away, while the other over the long term, while the other 99% of the millionaire population is staying and paying the higher tax rate. So, the way to think about this is, if there's a business owner in the room, think about that deal. You can raise your tax rate, you can raise the prices you're charging customers. That, of course, we love our customers, but raising the price by 10% and you lose 1% of your customers, that's a pretty good deal. That's going to raise a lot of money. You do lose 1% of your customers, but the other 99% are paying more. So that's, a business analogy to understanding what's happening here. And that's, I don't think, how a state should set its tax rates. But if you are thinking about, is this going to work? The answer is, yeah, it's going to raise a lot of revenue, even with this small amount of tax migration. Just like companies raise their prices knowing that, they will lose a few customers. Is that helpful?
Yeah. Well,
Um,
I guess of 15% of our 1,000 is 150 millionaires that my calculator's doing this right.
mhm.
But it's not 150 that move for tax purposes.
Oh, yeah, I know.
Only
If
less than
15
1% do.
Right, but if the migration is 15% across the board.
So just to clarify, that 15% is the share of movers
Okay, all right,
who move for tax purposes.
okay.
So 85% of millionaires moving across state lines. It's not about taxes. You know, like LeBron James moved from Ohio to California. He paid higher taxes. It wasn't a tax. It wasn't a tax move. You know, so it's
Here,
mostly when people move, it's not for tax reasons. It's for a lot of personal reasons.
it
15%.
snow in Florida like it does here. That.
Yeah, well, I'm in
Right,
upstate New York, so I
don't
completely
see it.
sympathize.
They go to Florida.
Yeah. Um, so of the people who move, so I don't know the numbers for Vermont on the millionaire migration rate in Vermont, but on average in the country, it's 2.4% of millionaires move in a given year. So you take that 1,000, you multiply 2.4, you're getting 24 movers, 15% of whom, if just applying the national statistics, 15% of whom would have been moving for tax reasons. So 24, 15% of 24, it's maybe three.
If I may, Dr. Young.
We got another question.
So in that though, I'd be concerned about the same
We've got-
concern you raised previously about selection bias, because you're applying a percentage from the whole population to a subgroup of millionaires, as projecting on those same rationales. But the millionaires I know live a different life than all of us at large. I don't know that many millionaires, by the way. I think I know more.
Yeah.
So I just wonder, can we really ascribe the same motivations on that subpopulation from the whole population if we have segregated them out based on one specific characteristic?
Yeah, so we're looking at movers. I mean, to answer your question, does Vermont follow the national pattern? And the answer is I don't know. Vermont is a different state than any other states, and ideally, you know, you would do this study one state at a time. Going through and sort of asking, are some states different? And, you know, I haven't had the time or resources to do that. And so I, you know, can't say for sure that Vermont would follow the national pattern. This is overall in general, what we see is, you know, low levels of sensitivity to the tax rate. So, you know, taxes go up by a bit and, you know, generates, you know, usually a good amount of grumbling, but, you know, little migration. I can give you a bit more intuition about the reasons for that. I don't want to cut off any questions.
Well, no, I'm gonna cut the questions off because our next witness is in the waiting.
Out of time, yeah.
You can wait
Okay.
minutes.
Well,
but-
the last thought I'll leave you with is, you
Finish
know,
first and we'll hold questions.
the last thought I'll just leave you with is that, you know, most adult movers are recent college graduates. They're relatively young and they're not paying the high tax rates. They're not in the top tax brackets, but they're highly mobile. And that's, you know, the population that, you know, is sensitive and is movable and is gettable. And that's, you know, every state sort of wants more rich people, but rich people are sort of late career, quite embedded in where they live and where they built their careers. And, you know, they've got homes and kids and, you know, as I say, you know, business associates, friendship networks, a lot of social capital in place, and they're just not that mobile. So, you know, I'll just jump down to this is what I'm sort of saying. These are migration rates sort of by education levels. You know, these highly educated folks are mobile for a few years, but who's making all the money and who's paying those top tax brackets are folks down here who all have very low migration.
Dr. Young, go back. You have the time you need.
Yeah, we
We're
want to
being
hear,
quiet.
we want to hear the whole presentation.
Oh, I'm sorry. I understood that we were out of time, and so, sure, yeah, yeah. Well, I definitely don't want to skip over anything. So, we can do another way of thinking about Vermont, and part of this analysis is just sort of thinking about places that live very close to, you know, a border with a lower tax. So the classic example that I focused on in this study was Washington and Oregon. This is the border in the country that has the largest tax difference, or at least, you know, again, these tax rates change a little bit, but it's basically the highest tax difference border in the country, running along the Columbia River here. And in fact, we've got a city, Portland, Oregon, that is sort of half on the Washington side, and over here it's called Vancouver, Washington, but it's one metro area. So Oregon has a top tax rate of 13%. Washington State does not have a state income tax. So, if you're one of these folks that's making a lot of money, it's pretty easy to sort of hop across this border, drive across the bridge for a much lower tax, for a much lower tax system. Um, as it happens, most of the millionaires along this border do live on the Oregon side. But this sort of motivates a broader example. Pretty much every state borders a state that has at least a slightly different tax system. Here we've got Vermont and New Hampshire also with the shading indicates how big the tax difference is. So in lots of places, the tax differences are not that big. Vermont, New Hampshire is one of the larger areas. California, Nevada, of course. So we wanted to look at all of these borders. So we're just looking at the borders, everything's shaded in gray. We're just sort of like, let's not worry about that right now. Let's just focus in on the areas where it should be the easiest to move for a different, some of these places, it's literally cross the street for a different tax rate. Move your house across the street, but to move your job across the street, but that's the idea, places where it should be easy to move. So we've got lots of cases to look at, to 16 years of data. So now what we've done here is just put all of these border county pairs into places. This is the 10% of border counties that have the highest tax difference. The tax difference at the border, the effective rate, the percent of your income you would pay if you switched, is about 6.5%. And over here, we've got states where the tax difference is negligible, right? So hopefully that's intuitive. So this is just showing you what would be the payoff to living on the other side of the border. Now, if, folks are conscious of this tax difference or are motivated to keep their taxes low, this is what we'd be expecting to see. Millionaires living on the low tax side of the border. That's why it's sort of inverted. These would be negative. This is not data. This is just showing the pattern that we're looking for. So this is like the more motivation, the more incentive there is to live on the low tax side. This is how it should play out. What we see in practice is just, not much of a pattern. If you looked at this for a long time, you might be able to convince yourself, maybe there's something sort of a little bit more negative on these higher tax differences, but it's not an impressive view. Again, this is what we were expecting to see, and we don't really see much in the sort of technical model. It comes out as not statistically significant. That matches with what we saw from New Jersey again. Being an example like this. So, okay, so just some basic sort of thoughts on this at this point. Look, millionaire tax flight does sometimes occur, but the magnitude is small. So if you think about, this title of the book, Myth of Millionaire Tax Flight, basically it's not that it's zero, but the magnitudes of millionaires moving for tax purposes is today just too small to really matter much for state tax policy making. Much more is driven by, if you just think about how many of these taxpayers do we have in our state, that's much more just a question of the underlying economic patterns that are happening in the state, millionaire people growing their incomes into that millionaire bracket, people whose incomes are growing into the millionaire tax bracket is the story, because these populations are generally geographically stable. So migration, it happens, but it's generally too small to really matter much for current tax policy. So if you wanted to ask, are we going to get the revenues? The revenues are definitely going to materialize. And again, I guess this is the part where I just sort of wanted to help give a little bit more intuition about this. Migration is a young person's game. It's not about rich people, it's about recent college graduates. Some of who might become rich, but let's see how this works. So, migration across the life course Here on the x-axis, we've got young adult going up into retirement age, and this is the migration rate. So what we're going to do is put people at different education levels on this line. This is from the census data. This is not tax data, and this isn't millionaires per se. We're sort of broadening out. You know, I don't have education on millionaires and stuff, just giving a broader view to try to understand what drives migration. So looking at data from the census. So these are folks who never completed high school. Their migration rates start out low when they're young and are low throughout their entire lives. People have some who graduated high school or have some college have a little bit higher migration rates when they're young, but that levels off, drops down. Here's where we're starting to see real migration. College graduates, recent college graduates migrated about 12% a year. But again, it converges very quickly with people who didn't graduate high school. They'll get master's degree or higher, your MBAs, your doctors and lawyers and so forth. This is where you get high migration rates. But, you know, by the time these folks are in their 40s, they all have the same low rate of migration. And so this is why I say migration is a young person's game, especially, you know, people with high human capital but are young. The thing that's not a young person's game is making a lot of money. And so the median age of a top earner is about 49. The median age of an adult mover is 30. So what this means is that, you know, people are deciding where to live and where to set down roots about 20 years before they hit their peak earnings. And as we can see from this data, you know, some people change that, you know, but very few. Once they sort of grow roots, they don't generally move. So, you know, I think rich people are really the wrong focus. I was starting to say this, but you know, every state wants more rich people, but they're just not very mobile. Future top income earners are highly mobile. And so I think, you know, a smart strategy for states is focusing on attracting and retaining people at the beginning of their career, highly educated future professionals, uh, at the beginning of their career. And what's driving them? It's not, you know, the top tax bracket, because honestly, they're not paying it and they've got much bigger priorities. You know, they're starting a family, they need to buy a house. They're going to have to worry about childcare for their kids, and all these things are going to come up a lot faster than the top tax rate, right? So, you know, quality of life and urban amenities, childcare, good school supports for young families are the things that I think, you know, can really help, states can really help make a difference for young folks starting out building their careers in the state, and some of them and going on to becoming, you know, some of the highest paid people in the state and some of the top taxpayers. But you know, that part kicks in once they've sort of already left the sort of phase of life where they're thinking about moving to other places. So hopefully that helps give some intuition about what's driving
Yes,
this
this
general
is
story.
helpful. Thank you. I've got one question, and we've been through the 15 minutes that we asked our next witness for. So,
Oh no.
Thank you.
Sit.
I'll be quick. I read, let's see, homelessness is a housing problem, and the Ezra Klein book, Abundance, and both of those books talk about housing as just a super critical piece of migration. And my question is, if you've dealt with housing, because we are concerned about young people not coming to our state, and frankly, New England, and all of the New England states have housing issues.
Yes, yeah,
Wondering if you
absolutely.
have dealt with that at all.
Yeah, I mean, I haven't done that analysis in the tax data, but I completely agree that, you know, it's a big driver of migration in general. Migration in general is driven by relatively low income folks, many of whom like have good education but aren't earning high salaries yet. And yeah, and buying a home and making that step of settling down is a very costly equation these days. So I did know we looked at census data for New Jersey as a larger part of that New Jersey case study. And what we saw in general is that people, you know, New Jersey does have high out migration. It's a very densely populated, it's the most densely populated state in the country. It does have high out migration. And where those folks are going is generally to places that have much more affordable housing stock. So, just to speak to that point, I do think it's pretty clear that housing is a big part of what a lot of people are struggling with and what is generally driving migration patterns. Now, I would say that millionaires, of course, they can sort of afford this stuff. Um, but I do think that housing is a much bigger priority. And if you're thinking about what's driving migration in Vermont, I would absolutely point to housing over taxes in a heartbeat.
Thank you.
Okay. Any other questions? We got one.
Public comment.
in the same
Public comment. Great presentation. I would be interested to dive deeper and to see if you've segregated types of millionaires before to look for stronger patterns of relationships. Like there's the paper millionaire, somebody who has with their house and their 401k more than $1 million in asset versus like a high net worth individual or a super high net worth individual, because there's like tiers or ultra high net worth individuals. I'd be curious, and also income millionaires, but I feel like you might find stronger relationships if you were to categorize the type of millionaire in a future analysis.
Sure. We absolutely have done that. I don't have this slide for you, but I could send a couple slides along with like the chapter where we do that. Not by wealth, because we don't have wealth in the tax returns. There isn't a wealth tax.
Yeah.
But we do have, how long, super millionaires, 10 millionaire, people who make $10 million a year, people who make $1 million a year in, year out, capital gains millionaires and so forth. And they're all in a sort of similar category. There isn't anyone that jumped out as being, highly mobile in our analysis.
Okay, thank you. Thank you very much.
Thank
This
you.
been
Wait,
helpful. What you got?
Okay. I just wanted to make sure you send along your slides because you went through them quickly. It'd be helpful to review them.
Sure, absolutely.
Thank you very much.
I'll add in that slide about, the different types of millionaires as well.
That would be very helpful. Thank you.
Great. You're welcome. Thank you.
Thank you. This has good. Okay, let's go on to. Okay, this is further testimony on 282, which is the wealth proceeds tax, and we have Miles Trinidad. And Miles, welcome. Thank you for being patient. Our last witness had a lot more data and information than I think we were anticipating. So we just ask you, welcome to the Senate Finance Committee, and ask you to just identify yourself for the record, and then the floor is yours.
Yeah, thanks for having me. My name is Miles Trinidad, and I'm a state analyst at the Institute of Taxation and Economic Policy. So I have some slides. I'm going to share my screen really quickly. Okay, you should be able to see it now.
We see it just
Okay.
fine.
Lovely. All right, is it still showing up correctly over there?
Yeah, we can see very well. Thank you.
All right, great. All right, so let's get started. So this is on a wealth proceeds tax. So my colleagues, Sarah Austin and Carl Davis, wrote a big report on this policy, explaining the reasoning behind this tax, the types of income subject to it, and a 50-state analysis of the revenue potential of this tax. And much of this that I'm presenting today can be found in this report. And so today I'm going to be going through the history of the tax, its potential to be administered simply at the state level, and the reasoning behind levying this tax that focuses on proceeds derived from owning wealth. And at any time during this presentation, feel free to interrupt me with any questions since I may not be able to see you, but there will also be an opportunity to ask questions at the end as well. So let's get started. So a bit of the background of this tax. So the origins of this started at the federal level with the passage of the Affordable Care Act in 2010. The bill included a major expansion in federal funding for healthcare, and that expansion was funded in parts with an additional payroll tax on wage income, and also a sister tax called the Net Investment Income Tax, or NIT. And that tax is passive income not earned through work, and that's the focus of this bill today. Introducing the NIT and the ACA ensured that workers wouldn't have to shoulder the cost of healthcare expansion on their own, and that very wealthy investors would also contribute. So getting into the nitty gritty, pun intended. The NIT is a federal tax levied at a 3.8% on passive capital gains, dividends, interest, business income, and certain annuities. And to be clear, the NIT is focused only on passive income. It excludes income of those types related to business or trade, or like wage income. And on the federal level, the law applies a $200,000 threshold for single filers and $250,000 for joint filers. And if filers' income is below that threshold, they don't owe any NITs, period, regardless if their income is from wealth or work. And for those with the income above it, only the portion of passive income that exceeds the threshold is taxable under the NIT. So the reason why I'm telling you all of this is because this federal policy provides a valuable framework for states looking to tax passive income of high-income households. And in 2022, just 4% of Vermont households owed this federal tax on their passive income. And the federal NIT is built around an IRS audited definition of passive income that states can conform to in order to create their own tax on the proceeds from owning wealth, and to ensure that this tax is well targeted to those best able to pay the tax. And a great example of this is Minnesota, which passed this state level tax in 2023. At the time, Minnesota lawmakers were looking for a way to fund free school meals and ultimately chose this tax on passive income as one major part of that package. And rather than opening up a big, messy debate on how to define passive income, lawmakers chose to simply piggyback off the NIT, which is generally quite sensible. Lawmakers there made some adjustments to the federal structure, like increasing the threshold to $1 million and exempting certain agricultural property, and then they applied a 1% tax rate. And this year, we expect their tax to bring in about $68 million in revenue. And another lesson from Minnesota on how simple this tax is to administer is because they chose to conform to the federal NITs. And even with some of the departures from the federal structure, their state's schedule NIT is still on a single page of worksheets. And the fact that the IRS already has issued guidance on the federal NITs and already looks at audits and flags non-compliant returns, all of this helps to make this policy simple to administer and easy to comply with. And so now looking a little bit more closely at S282, which would create a state level wealth proceeds tax in Vermont that piggybacks off the NITs. So this would create a 4% wealth tax on investments, on investment income, sorry. And like the federal NITs, the wealth proceeds tax applies to individuals, estates, and trusts with investment income over the federal threshold amounts. In addition to the passive income that is taxed by the federal NITs, this bill incorporates a few modifications that I'll describe in a moment. And the bill also guards against using trusts to avoid this tax, which we'll also touch on later. And this bill assists with a tax on certain investment income, similar to the same thresholds in the federal bill, or the federal law, sorry, of $200,000 for single households or $250,000 for joints, and then also $16,000 for certain trusts and estates. So an example of who would be subject to this NITs. Imagine how each of these bars might represent the income of various tax filers broken down by wage in blue and passive income in green. On the left, you can see 3 examples of filers who would not owe any tax, such as people who only have passive income, or a mix of those who would have wage and salary income. So this group on the left comprises of about only 96% of all Vermonters, so those people would not be subject to this bill. On the right, you can see 2 examples of filers, one with all investment income and the other with a high salary supplemented by some investment income. Both of these would pay tax only on the portion of investment income that exceeds the threshold amount. So similar to like a marginal tax bracket. And about 4% of Vermonters would fall into this category. As far as what counts for investment income or wealth proceeds, this bill adopts the federal definition of net investment income used by the NIT, but would also make some modifications. So the federal NIT taxes capital gains or profits from selling property, stocks, dividends, which are payouts of corporate profits to shareholders, a variety of income from business ownership like rents or royalty income or business profits, as well as trust income, interest, and non-qualified annuities. And then this bill would make some modifications, starting with excluding federal bond interest, which states legally cannot tax. And then the bill also adds interest from out-of-state bonds and capital gains to the extent that they're excluded from the NITs, including those from business sales, opportunity zones, and qualified business stock exclusions. All of these capital gains are already federally tax preferred, but the capital gains from opportunity zones and qualified small business stock are often completely tax-free at the state and the federal level. In general, wealth proceeds are very lightly taxed income at the federal level. Long-term capital gains, qualified dividends, we estimate to make up about 80% of the base of this tax, and they face a federal tax rate that tops out at 23.8%. Between the federal income tax and net investment income tax rate. Compared to that, the top federal rates on wages are 70% higher at 40.8% when considering the income tax and the net sister payroll tax, the additional Medicare tax. So in total, about 83% of this tax base in this bill enjoys preferential federal income tax treatment. In addition, all of the income tax by this proposal is excluded from state unemployment insurance and federal FICA and payroll taxes. So this table kind of goes into further detail on the types of income at issue here and our federal tax treatment. All you can see is treated very differently than you would from someone who maybe would just receive a W-2. So earlier I flagged something I want to touch on regarding trusts. So trusts hold wealth that is often invested, and when these investments yield profits, income tax is owed only on the profits generated in a given tax year, only if the trust doesn't pay out the profits to its beneficiaries. So something this committee should know is that a practice tax funds promote to avoid state income taxes is called ING trusts, also known as incomplete non-grantor trusts, which shift income out of state. This bill includes language modeled after New York to nullify the income shifting effects of these trusts, and brings the income from these trusts back under the rightful jurisdiction of the Vermont tax code. This is important to include in a wealth proceeds tax because passive income is easy to move into trusts. And it's also worth having on your radar more generally because there's reason to be believed that aggressive use of ING trusts may already be undercutting Vermont's state personal income tax as well. And then finally, on the topic of estates, some large estates may take years to settle, and during this time, assets within the estate can generate income. And it's this income that is subject to the income tax and potentially taxable under a wealth proceeds tax. And this is an entirely separate issue from an estate tax, which is owed on the wealth of an estate. So far I've been talking about what the wealth proceeds tax, but I'd also want to make very clear what this isn't. There are common points of confusion that I want to clear up. So first, we have capital gains from selling a primary residence. This is not included. Sorry, let me back up. So we have capital gains from selling a primary residence, which is not included in the nets. For capital gains up to $250,000 for single filers and $500,000 for married. And an important distinction is that these numbers are related to the net profit of a home and not the full sale price. And then while wealth proceeds do not include profits from passive business investments, they do not include business profits from a business the filer is, quote, materially participating in. So the test for this is generally a requirements with a minimal number of working hours, as few as 100 hours over the tax year. And most business income is not passive and is therefore exempt from this tax. And then finally, traditional retirement income is fully exempt from this tax. So that's like Social Security, pensions, 401ks, 403bs, qualified annuities. So the bill does not tax retirement income. And then one thing we did want to flag is a technical note to this bill. So this bill references taxable income, but we would suggest changing it to federal modified adjusted gross income. That's the definition used with the federal net thresholds. So we generally recommend using the same yardstick to make it kind of simple and easy to kind of translate this tax from the federal level to the state level. And then the threshold definition should also have these modifications to ensure a kind of like apples to apples comparison when applying this threshold. And then finally, the estimate from the wealth proceeds tax in this bill, we estimate to raise about $75 million annually for Vermont. This would come at a good time as the state navigates, federal funding cuts for hunger and healthcare programs. And in addition, the tax is also well designed to target income that is highly tax deferred at the federal level and would avoid further taxing families struggling to make ends meet. So that's the end of my slides. So thank you again for the opportunity to present to you all, and I welcome any questions you may have.
Okay, I've got one, Senator Chittenden.
Could you go back to slide 10? You jumped over this, and I'm really trying to understand what these columns represent and if they're Vermont context specific. Can you
This
go
one?
through? Yeah, so walk me through what each column represents to you and what I should be taking from this outlay.
Yes. So on this first column here is a share of like the wealth proceeds tax base. So this is like, the proportion of how much income or how much of the base is being taxed, or what it comprises of the overall taxable income from all of these categories. So over here, long-term gains is about 39%. And then this column to the right is if it's preference under an individual income tax. So as we mentioned before, like the top tax rates for an individual income tax is 40%, but because it's like a long-term capital gains, it's taxed at a lower rate of about, an effective 23.8% tax rate. So these ones that have the green column, these are generally taxed lower than someone who may be, working a 9 to 5. And then on this column over here is it's exempt from the federal nets. So these ones, I think it's kind of self-explanatory. And then this one is over here is the exempt from FICA and Social Security payroll taxes. So all of these wouldn't be subject to, but somebody who would working a 9 to 5 would pay on their wages towards Social Security or Medicaid.
I just have to clarify. So is this for Vermont specific, how you're breaking apart what the anticipated revenues might be from S282? That's what this 39.1%, that 39.1
Yes.
of the
Yeah, this is Vermont specific.
that anticipated revenue base. I don't see it specifically in the slides. Was it 68 million?
75 million.
75. So you're saying that about 39.1% of that 79 million would come from taxing long-term gains that are currently subject to the federal net income and investment income tax.
Yes, that's exactly correct.
That's very helpful. Thank you. Now I understand.
Okay.
Mhm.
I think,
Because I'm concerned about taxing capital gains.
We might, yeah.
It's what,
I think the closer we could model this on the federal, thus the easier it would be for the tax department and tax filers, would be probably helpful. Is that pretty much what Minnesota did? I mean, if we could get one page, for filer, that would cut down a lot of the opposition, I think.
Yeah, that's exactly what Minnesota did. There's only a few alterations. They just changed the threshold for who would be subject to the tax, and I think they excluded agricultural property. So just like, a simple subtraction from what was included on the federal level.
We do have, one of the things was this bill didn't comply with Vermont's capital gains on business and farm property sales.
It didn't.
It was different from.
It was different.
We
Okay.
have an exemption and this one didn't. The bill didn't recognize the Vermont. I think agricultural sales would probably have to be figured in. Okay. So that is helpful. Any other questions? Chittenden again.
Me again. So those first two, long-term gains subject, long-term gains exempt. In your mind, is there clear discriminators on those types of gains within there versus their gains on a stock position versus a physical land asset versus a business interest that's domiciled in the great state of Vermont? Is there clear delineations of those gains that are discernible through tax policy?
That's a good question. I'm not quite sure if I can answer that. I can go follow up with my colleagues who drafted this report and did the state-by-state analysis and see if I can get a little bit more detail on how that's differentiated.
Any time you could spare would be appreciated.
Okay.
I mean, I think it's the third column over there. There's just the two green yeses there. those are the additional things that are in S-282 that are not in federal bill. Is that correct? Am I understanding that correctly?
Yes, I think that's correct.
Okay, so if we were to do what
Long-term
Minnesota
gain.
did and just model it exactly off the federal program, we would not have those additional long-term gains. And we would not have the interest on out-of-state bonds. You know,
Right.
if we were to do what Minnesota did and mirror the federal one.
At the $1 million trigger.
Well, I don't know what the trigger is. We would have to,
Yeah, and
Got
but the
Yeah.
concerning one is probably the 23%.
that would decrease the revenue.
Yes, by
Yeah,
23%.
By 23%.
That, yes, out of state bonds is gonna be decimal dust, but 23 for the long-term gains exempt from federal. So we'd have to find out what that is and how it complies with our long-term gains. And I think part of the testimony we missed yesterday was that, I think, you know, they were sitting here waiting for us yesterday, so yeah. No, that was another one. So we will get them in if we're gonna move this forward. Any questions for this witness at this point?
Thank you.
Okay, thank you. This
Great, thank-
is. Okay. Committee. We're planning our last week. And. Yeah. I'd like to have a short, if this bill, you see what I'm planning to go forward with. I'm planning to get out the portable water, the water hookup connection. We're waiting for numbers from A&R and we'll get those. 220, I'm gonna put on if we got the votes for that one.
On that, Madam Chair,
Yeah,
can we broaden that discussion to look at excess spending?
you
threshold?
can,
Okay.
it's on for discussion. Okay, no, motor vehicles is the week after. We don't have to do them.
On the S-220 before you go much.
Well,
further.
that's where I'm gonna get back to. 211, I just want to know, yes, what. There isn't enough interest in to make it even worth taking up the agenda. I think the two I've got on there, one is S-161, that's the scholarships. I think we need to talk about that. I don't know. I'm not sure where the support is on that one. There is a proposal in the House, which I've been told is a flat no. But there will be a vehicle coming if we change our mind. 220, there isn't a vehicle, but it is a tax, so if we can't reach agreement on that. But this one is the one I'm interested in. Is there a possibility of our getting out some variation of this taxing on investments, capital gains? I like to make it as similar to the federal, just so you've got Minnesota's one page. I think we might have to look, well, we'll have to do some more work on that capital gains exemption for agriculture and see what Minnesota did. And we've got agriculture and business, but I'm just wondering, is this something that's gonna go anywhere? Is it worth working on?
What, like, if you did that, what problem would we be solved?
We'd be raising some money for school construction. The problem is we have no money for school construction.
That's what the bill says, right?
That's what the bill
where the
says.
bill took the revenue.
Yes,
I mean, we could do it that way, or we could
we could just raise revenue, and I know. When we had the joint hearing on the federal. Federal revenue impact for the new tax changes. The analysis was that it would be the corporate income tax. Would be about $1 million, and it would be like decimal dust. Well, I guess further analysis, it's looking like it's a lot more than decimal dust. And the governor's budget, it's more like 25 million. That was the last I think I heard. Anyway, the budget and the revenue estimates were different on this one.
Sure.
So the appropriations committee are doing some cleanup, and the House is going to be sending us, I think, a miscellaneous tax, a decoupling for corporate, so that we don't lose $25 million. Corporate is kind of erratic anyway, but there was some concern that usually most corporations seem to let overpayments that, they make quarterly payments if they don't owe it, rather than get a rebate, they'll just let it ride. So to just kind of cover their tax for next year. And the tax department said maybe at the e-board, they were seeing a lot more corporations just taking their return and not letting it carry over. And they're saying now that they've seen what the reductions are going to be in corporate tax, they understand why maybe they're thinking they aren't going to owe any tax next year. So that's moving pieces. The House rewrote the corporate tax code 3 years ago. It is a revenue bill, so they are starting it there. But that one will be coming. But that's a whole. But this one would do the same, would tax these assets the same in Vermont as they do at the federal level. It starts lower. It was passed to fund the Affordable Care Act, was the testimony. And I'd like to start it higher than 200,000, but if that's an income, that's where you have to start bottom. But it isn't that much per taxpayer, and for most taxpayers, and it would get us some school construction or maybe some other money that we need to fill other holes. I'm sure we can send it out of here to school construction, but it will have a long journey. And if there's revenue attached to it, I'm sure the appropriations committee will look at it. But that's what I'm thinking, is, and if you're no, or what further information do people need? I'm not going to talk about I haven't got a bill to get any changes in the taxing whatever, or adjusting rates. That will work on, because miscellaneous tax is coming. But this is one that could go now. It could get attached to miscellaneous tax too, but I'm divvying up time. So
I would like, I think, obviously, to see the analysis with, if we do match it up exactly with the feds, what would it look like? If we do something like Minnesota did with the ag property, what would it look like?
what we have to
And
do,
then-
make it compliant to our capital gains
Right, so what would it look like? And then if we were to move around the income, I actually think that moving it won't make that much difference, because it's about how many people make this kind of passive income, and not that many people do.
No, we had that chart.
Yeah,
If,
So
if the
it's-
bulk was at the very top.
exactly, it's not that many people. So I mean, and in terms of what we could do with the revenue, depending on how all of this shakes out and whatever. Is we could put some of it to school construction to start building that fund. And if we wanted to do what Minnesota did, we could put, 18 million of it towards school lunches, and that would lower property taxes.
Yes, we could, couldn't we? And that would take that off the table.
Yep.
Okay. I'm looking at this,
Should we walk through the bill again when we get back?
oh yeah,
Okay.
we're gonna walk through it. I'm just, well, if there's enough interest, we'll walk through it. If nobody's interested.
I'm interested in learning more about,
Okay.
what
That-
these changes
that's
would look like.
What I'm looking.
Yes, I
Who
think
do I
it's
need?
intriguing.
So we will ask joint fiscal if they can model for us.
Come on, aren't you curious to
Well,
learn more about?
You know, I think I've learned.
And I
that
think
so
I've already
far.
asked them to model it.
Yeah.
If it adjusted the income up, and if it, that would be up for inflation. $13 now, and if it were brought into compliance with our agriculture and business capital gains exemptions, and see what we can get.
So those are the comments I'd make. Just looking for others to speak, is that if this moves forward, I would have serious concerns and pause if we don't segregate out those very frequent one-time millionaires in Vermont, because I don't really think they are millionaires. They're cashing out at the end of their life cycle. So that's why the capital gains is an important piece to me. But if we look at the passive incomes, I'm happy to explore how that would model out and how it could be consistent. But that's for individuals that get those dollars at higher amounts off of passive income for years forward. So any way to segregate those things, I'm interested in knowing more,
Okay.
but that will drastically reduce the 78 million from those figures. I mean, then we're talking already down to like 30 million or less, but maybe that'll pay
But I
more.
don't think it's the same kind.
Yeah, well, I think
income.
that's what
Specific kind,
we.
yeah.
That's what I need.
Someone
Yeah.
come talk to us about Vermont's
That's my
capital
pause,
gains.
my hang up.
Yeah,
Probably
I think it was,
Joint fiscal.
but we walked through it a long time ago, but I remember there's a distinction between.
So how many attributes do we have? Let's set up one. To do capital gains at Kirby. This might be the week we go later than 4 o'clock.
Not today, next.
Everybody has this puzzled expression.
Today.
Well, I'm just thinking of this in the context of, that's why I asked for the question. What probably, if this is about a way to spend even more money, that's where I start to get a little lost.
The proposal is to find some money for school construction, because we aren't gonna be able to consolidate schools if we don't build a classroom here or there, or patch a leaky roof. That's the original proposal. The other one is, well, if we could replace the money that we're spending out of the property tax to pay for school lunches, which is what they did in Minnesota.
Yeah,
That's all the kids hugging the governor.
that's not a good spend.
That is not in this bill. No, this is a revenue raising bill. To
I look at-
offset,
I look at 2.5 billion for 82,000 kids. And it seems to me like there's room in there for school construction. But we're not
Oh.
spending it on school construction right now.
no, we do not have an actual income source for school construction.
It seems to you? Is that?
Yeah, I think that it's 2.5 billion, there's room, there's capacity there for school construction.
Wait,
It's not being
Can you
spent on
elaborate?
school.
That's the total cost.
I understand, but that's one of the biggest things the government does is education. So yes, it is a big
it's a big item, so can you expand on your
I think
thoughts?
2.5 billion for 82,000 is too much. And I think the capacity is within there to pay for school construction without raising the revenue.
Again, but you didn't actually expand. on
No,
that thought.
I think it's getting down to,
You repeated
we're
it.
spending a lot of money per student
I
across.
think we all understand that, and we all understand there's a need for reform. I just am trying to figure out where that money's gonna come from. Where is
Well,
it?
when we figure
Well,
out
it's
how
in-
we're
it's
gonna
industry
reform,
that
then.
It's 80% personnel based.
So just get rid of personnel.
We're
And then we
staffed,
can build.
we're staffed pretty high rate.
We have the highest per.
No, I'm
And
well aware of all the issues.
I know, but
And
it
you can't
is.
compare apples to apples. There are other states that do not put a lot of the things that we put into our quote unquote per pupil spending, so it's apples to oranges.
It's got a way to get rid of
It
school.
would be nice to right size that and so that we're doing the apples to apples
I
comparison,
completely agree.
which is
Let's
exactly.
let's do
you're right.
it right. Let's not just like,
Okay, we're
Yeah.
getting in to a discussion of a bill that isn't here. 282. Randy, any possibility, any more information
On what?
on the capital gains passive?
The knit,
which is an unfortunate name, by the way.
What?
Yeah.
knit,
Yeah.
and I
I can't hear it yet.
Knit. Would you like me to posit something?
Yeah.
Because I actually do think Senator Beckett's asked a good question, which is what problem we're trying to solve. And there's definitely the question of school construction and education and all of that. There's also, we have to understand the environment we're in where we are, money that we've had is removed now in terms of Medicaid enhanced subsidies, in terms of what, but you know, look, we can flesh all of that out if we want to. But this is. And the tax cuts for the super wealthy, right? They're already super wealthy and now they're getting more in the form of tax cuts to the tune of what? Almost $60,000 a year. So this is an opportunity to, I use the word claw back for lack of a better term, but to get some of the money that we've lost and are losing back.
Okay,
It's not like we're just like adding spending, it's, we're trying to hold on.
I want to try that. I'm,
Yeah, but
there's a new form letter out that is doing,
We're not
and that
losing
57,000
federal.
number
So we don't
is.
lose, the state isn't losing money.
Yes, we are.
yeah, we are.
Not the extent that they're saving 60,000 at the federal level. Per fact there.
Well, when your tax bill, your health insurance goes from $4,000 to $45,000 a year, that's a big
That's a
hit.
loss.
I'll frame it
No,
slightly, oh, sorry.
no, I was just gonna say that. You're trying to claw back the federal tax, they're saving on their federal taxes, that's what you're saying, you want to claw back. So that's gonna put Vermont at a disadvantage if other states. Obviously don't try to claw back, that puts us behind,
Well,
because it's a federal law.
but I think the point that Senator Cummings was making was that one of the ways that we have seen an increase because of the federal tax cuts, that they cut tax, they cut, and then, well, is the increase in healthcare costs that we're seeing, like enormous increases in healthcare costs because of the lack of the federal subsidies. So that is increasing Vermonters' healthcare costs substantially.
Increasing
so-
everybody.
So that's everybody, yeah.
So if we are able to, you know, raise some revenue through the tax capacity that has been freed up because the federal government greatly reduced taxes
The
on wealthy
federal-
people. I know, but that increased,
Yeah.
that freed up tax capacity. So, you know, taking advantage of the freed up tax capacity to try to fill a hole that the federal government created, I think is a
Well, I-
valid thing to be considering.
That's
So-
what I'm not clear on, is where that
Because
57,
every other state does not try to claw back that money,
yeah.
Vermont is further behind.
But we heard from Patrick Titterton that many states are, as a matter of fact, trying to claw that money back.
Okay, my first question is where that $57,000 number is coming from. I'm getting some,
What's
I've had letters that say it's obscene, but the federal government has just given millionaires a $57,000 tax decrease. I'm looking at decrease. I'm looking at the changes in HR 1. Corporations were the big winners. All right. There is that I'm seeing, there is no actual rate reduction. What they did is they extended the rate. They made permanent the rate reduction that they did in 2017. We did make adjustments for that rate reduction in 17. So it's not that they're getting $57,000 more sent back to them this year. They're just paying the same taxes they have since 2017. So the mental, they've still got a lot more money than the average Vermonter, but it's not like, oh, they just gave this to me, so I'm going to give it to you. They're pretty used to it, just like we're all pretty used to getting, you know, all the raised automatic deductions.
Well, I think
exemptions.
I think your point before though, Madam Chair, is a good one, is that people were used to getting the subsidies and they're not getting them.
They are not, no, and it is a shock.
decrease in people's
Right.
expendable income who are relying on
But
this stuff.
this is touted to school construction right now.
Right, for sure. I mean, we can,
Yeah, and we
Have
have
that discussion.
other things, so.
So on that, I want to reframe some of this and what I think we do need to do, because I think it was bad policy that many of us were in the building when we did this, when we tacked on universal meals without paying for it. We, as a legislature, required this at the tune of originally $30 million, and we just forced all the communities out there to have to pay for it. We're not going to repeal it. It seems like this governor has gone to the point, and seems like we're all in agreement that we want to keep feeding kids universally, that I think it's the right thing. That's where I'm open to new revenues. I agree. We have to look at our spending. We have reduced students. We got to find ways to gracefully do this in ways that don't decimate our local public schools and also provide good education. But I do think that we need to correct the wrong that we've been feeling the last 3 years, which is we put an unfunded mandate on the ed fund. And so that's where I do support finding sensible ways. And that's what I really like what you were talking about before, Madam Chair. I don't know if we can fold this into it, but looking at our existing tax rates, really recalibrating them in a way that is sensible and aligned with the new federal.
We are not
landscape
going to be able
also
to
pay
do
for
that
this.
in the next week. My goal is
How much is universal?
trying
Oh,
to get,
2.5.
is to put that on miscellaneous tax that, I'm looking at
But that would have
the
a real
ability
impact
to-
on the
that's why I suggested.
to to attract those folks coming out of medical school,
The other thing I want to say, and so that's where I
other things.
do support new revenues, because I think that's rational and it corrects what I think was an oversight on our part. The other thing, I want to be absolutely realistic, and I want to say the quiet part out loud is, I mean, if we put forward new revenues, I don't feel like this governor is going to sign it, so we're going to play some sort of standoff chicken.
Well, if we do
Who
this.
knows?
then-
But if that's the game we're gonna play and we're gonna go down that path, just recognizing that dynamic, if we have to vote this through to stand on our principles, recognizing it's not ultimately gonna be passed into law. I just want to focus on the feasible, and I'm wondering if there's a feasible path.
Part of
on
the
universal
path
meal.
also has to be focused on the expenses. When you look at Vermont and you look at the cost of education, and particularly the number of people who are not teachers in the classrooms in Vermont compared to the rest of the universe, we're high. We're off the edge.
Yeah.
One of the things that we do need to do ultimately, we probably won't do it in this session, but we need to plan for doing it, is getting expenses where they belong. Because one of the reasons our education costs are so high is because we have stuff in it that's not in the education budgets of other states, and that itself may throw us up.
Well, we could move some of those expenses off the ed fund and pay for them with this this new revenue. That's another thing. We could move some of the mental health and social services costs off the ag fund.
See, well, I think we should certainly look at it.
We could pay for them with this new revenue and that would reduce property taxes and.
All right, we will be,
And we also need some additional consulting advice
But I think.
within the next week. And by that, I mean, every time we go and we get consultants from the Public Assets Institute, we're recommended another. And when you look at the evaluation of consultants, they're always left or far left as the people we talked with today. And we need a balance of that to say, are we getting the thing? Now, I don't know about
First, I
you.
was a
I have
professor.
never met a person who lives in New Hampshire who moved to Vermont. Who's a high income. I've never met one.
why, get, ready to get us a name.
All right,
Okay.
I'll work on that
Guys,
next
work
week,
on
get
that.
somebody in here if we know what day we want them in.
But I'm thinking this could turn out. We're raising some revenue. Okay, if we bring things in
I looked
line,
at that for
but we may
Oregon and
have,
Washington. One's been 1.7.
if we put it in the education fund to buy, pay for school lunches. And we could actually, what I'm struggling with, if we could put it into ed, we could bring down property taxes. If we keep it from being stolen for transportation. What's going through my mind is we raised hell because the House raised taxes, put them on a specific program. They never went, the revenue never went through the appropriations process. That won't happen here. I think we can. Yeah, there were 3 bills that we just told the committees of jurisdiction, don't even think about it because we're not raising
How about,
those taxes. But I think that we could have that discussion because we would be raising groups and arguably people with more wealth than others, probably than the average, to bring down the property tax cost or to take an unfunded mandate out of there. And we might even find enough money to give a cost of living increase to those designated agencies, which are supposed to be dealing with the mental health issues.
you go first. I just want to say, I think we all, although we end up sort of feeling like we're on different sides of the fence, I actually think we all have very similar goals. And this, I think it's really important that we don't see this as a zero-sum game. We can cut costs and maybe we can increase some revenue. We can do both and we can solve some problems. This isn't an either or. And I think many of us want education reform, full stop. We want to do it right. There's not a heck of a lot in Act 73 that is going to radically lower our property taxes, guys. That is the truth. And I even think I've heard you say that before, Senator Beck.
No, you did.
I believe I did some in our, but anyway. So if there is, show me where there is radical decreases in spending in Act 73.
Okay, we're getting off the subject here. I'd like us to all go home.
Got it, good. I was trying to do the kumbaya thing, it didn't quite work.
I'll settle for no fifth.
I do like the idea of a
Have a
big
good week
tax
off,
that rather seems
Yeah,
spending,
yes.
You've already seated before to me, now it's your turn.
where there's little bit of
Okay,
this,
Randy's
little bit of that.
All right.
Madam Chair, if I might, before everyone leaves, I'm happy to look at the ed fund expenses and see about if there's like a way similar to like, okay, we just pay for school lunches with this. We could figure out a way to portion off some of those sort of extra expenses that are on that.
Yeah.
Would that be helpful?
Yeah, I think.
This is tied into that big
And we,
grant.
you know, we can, in the end, there's going to be a package. to get everybody on
That's why I'm
board,
happy
in
to just
the
put my whole
end,
oil.
there is.
It's gonna be a grand bargain.
There is, yeah, because